Hello, everyone, and thank you for joining us for this month's KJH Insights podcast. I'm Sarah Bull, Senior Portfolio Manager at KJH Investors, and as always, our goal with this podcast is to help clients make sense of the market environment and understand how we are thinking about protecting and growing their capital through changing cycles. I'd like to welcome Andrew Sumerick back to the podcast today. Andrew is a Senior Portfolio Manager and a key member of the KJH investment team. Andrew, great to have you on again.
Hey, Sarah, thanks for having me.
Of course. So, Andrew, let's get started here. Last month, we spent a lot of time discussing what you and Peter referred to as the one variable market, where oil and I guess geopolitical developments were effectively driving every move in equities. But really, what's been remarkable is just how quickly that narrative has shifted. Over the past several weeks since our last podcast, volatility has eased, and oil markets really seem to be pricing in some sort of normalization of tensions with Iran, and equities have staged an extraordinarily sharp recovery off the lows. In the webinar last week to clients, you said one of the fastest rebounds we've seen outside of periods like COVID. So, beneath all of this surface, there's obviously some complex dynamics happening as well. So today, Andrew, what I was hoping you could do is unpack what's driving the rally and what your thinking is about positioning portfolios through what remains now, again, a narrow and complex market environment.
Sure, it's a good spot to start. So you're right that we had a 9% correction earlier this year, or 10% plus, depending on the indices that you're quoting. And now we're currently at all-time highs in the S&P 500. So you're correct in saying it was quite a fast rally. And one of the biggest questions we get is how can the market be at all-time highs when we still have so much uncertainty with the war? And the simple answer that we like to say is the market is forward-looking. So if you're waiting for there to be a full resolution, it's likely already too late. But what does that mean when we say the market is forward-looking? And what do we believe is actually driving markets to all-time highs? And so we were talking about there's a few things that are driving it, and I'm happy to dig deeper into any of them. But first, if you look at what you spoke at the beginning, the market being less focused on oil than it was prior. We used to say, it was only a month or two ago where we said before we went to bed at night, we were looking at oil markets. When we woke up, we were looking at oil markets because that would basically tell you what direction the markets were heading. But we saw that basically break down in about mid-April. And really, we believe that's the market saying this is a short-term issue, but longer term, not as impactful. So that'd be the first driving it. Second, we've gotten more data out of the US economy, and it continues to be extremely resilient. So GDP growth continuing around 2% and looks to be accelerating into Q3. We just saw weekly jobless claims. So the labor market is still really strong. Weekly jobless claims at the lowest level since 1969. And we had non-farm payrolls last week, which surprised positively and led to the fastest 2-month job growth that we've seen in years. So the labor market is definitely healthy. Another area that's driving things, earnings growth. We're just wrapping up the earnings season here. And it's one of the best earnings seasons that we've seen in a while. One, from an absolute point of view, and also from beating expectations. So the market came in expecting around 12% earnings growth. Will probably be over 20% this quarter. So earnings are definitely driving the market. And then the last thing that we believe to be driving a lot of this rally is kind of call it the return of the mega caps. We spoke earlier about how the Magnificent Seven had been laggards into the beginning of this year. In fact, at the beginning of April, every single Magnificent Seven company was down for the year, and all but Apple were down double digits. So they were seeing a pretty significant pullback. But very quickly, that's shifted as growth for some are now reaccelerating. And now over half of them have positive returns on the year. So these are big drivers for the S&P 500 because of their such a large weight. So having that kind of narrative change has helped drive markets higher as well. So we've kind of been saying those are the 3 or 4 main things that we believe have been driving this rally.
Yeah, great. Okay, so let's dig deeper on some of those themes then. On oil, Do you think the oil markets are correctly pricing in normalization then, or do you think they're underestimating geopolitical risk?
I think, like usual, it's hard to say the markets are getting anything specifically wrong in the moment in time. There still is a lot of volatility. So I guess the oil markets themselves are still moving a lot on every ceasefire or tweet that seems to come out one way or the other. So there still is a lot of volatility in that short term price of oil. The long term price of oil, which I think we spoke about on the last podcast, which is if you needed oil 9 months out, it is still slowly rising, but it's in, call it the 75 to 80 range, so much more manageable. So I think what the market is saying, and I tend to agree with it, is that yes, there is significant variability right now, and there's also variability in where you're getting the oil from. So countries that need energy out of the Middle East, it is a current situation that is worth monitoring, and prices are different on, if it's, we even quote Brent, we quote WTI, but there's also Middle East pricing. And so in the short term, I think there is a lot of issues with getting energy and moving it around the world. But generally speaking, I think, looking out 6 to 9 months, it does seem to be like this is not a conflict that many parties want to last that long. And so I think that's why the market is looking at it. And I think that's why the relationship, which we said before was basically perfectly negatively correlated between oil price movements and the market, has really broken down since then. So I'd say the market, are they getting it completely right? Time will tell. But at the moment, the breakdown is more on the basis of they're probably expecting in the next 6 to 9 months, oil markets will be much calmer.
And is that the idea that traffic in the Strait of Hormuz then will kind of return to normal and that the economy can operate on $80 to $90 oil?
Yeah, I think that's probably fair. What the eventual price of oil will be, I don't think it goes right back to the $65 we saw earlier. There'll be some transition time moving ships through the strait. How do we eventually get there? I don't know the exact mapping out of what it will be. There's a lot of people behind closed doors working on that right now, and they probably don't even know either. But if you get some type of resolution, oil is able to flow through, then you will start saying, okay, what kind of damage was actually done to supply longer term? On the flip side, you've had a lot of increased production in different parts of the world because of the incentive at higher oil prices, which is generally how commodity markets work. It's not there's never just one variable driving things. And so if we're back into the 70 to $80 oil range, I think that's an area that the economy can withstand. And also, if you think we're here in North America, a lot of companies can make good money. A lot of energy companies can make good returns at those prices. So I think you're probably right. That could be an area that we're heading towards.
And on the AI side, is it really the AI infrastructure trade that's creating this bifurcation again in the market with the seven tech stocks?
Yeah, so the main thing to think about is how quickly things are changing. Just at the end of last year into the beginning of this year, it was that artificial intelligence companies had moved so fast, they were spending so much money, and the question started to become on the return on invested capital or return on capital that these companies would actually see from what they were spending. And that's why they kind of got bid down. And growth rates, people were wondering, are we in a bubble? There was all those discussions. And that was really only over the course of about 2 months, all those things were happening. And in the last month and a half, what you're seeing is companies like Google and Amazon, which they're the cloud infrastructure players for a lot of these. I'll use Google as an example. Their growth is accelerating from what it was. So these are already massive companies, trillion-dollar businesses, and Google just printed a 63% year-over-year growth rate in their most important business. Amazon's accelerating from, they were in the high teens to around 20%. Now they're going to be 30% plus going forward. So these aren't just, they don't just have growth. The rate of growth is accelerating. The reason being is just the models are changing so fast. And they are starting to talk about some of the returns they're seeing, the demands that they're seeing. It's okay. Before it was you're spending all this money, where are the returns coming from? Now it's you're starting to see the returns. And these are mass amounts of money and mass amounts of capex that is being spent. And so the market's liking a lot of these companies that are able to reaccelerate their growth on the back of the capital that they're spending, which is what everybody wanted to see. And then I think the trickle down effect is, if the four biggest hyperscalers are going to spend $750 billion this year in capital, there's a lot of companies that benefit from that down the value chain. So and that number is probably going to grow next year. So you think, what kind of impact does that have on the economy? So AI gets thrown around a ton, but you're right that the infrastructure that goes into it is driving things right now, but you're also seeing the actual demand. You're seeing some revenue come from it. So there's definitely a lot of that is driving not just the AI trade, the AI related, but also you're starting to see it in other companies as well.
I'm glad you brought that up because a lot of people ask whether this AI boom is a repeat of the tech bubble. And really, I think it's fundamentally different because of what you just said.
Yeah, and bubbles get thrown around a lot. And anytime that you see a huge technological improvement or breakthrough, you are going to have excesses. That's just the function of the market. We talked about the internet, we talked about the industrial revolution. There's many different parts that you need to overinvest because it's so difficult to catch up to demand. The way that you get into trouble, I think, is how you finance these technological breakthroughs. So we've spoken about in the past, the biggest difference, I think, in this go around from call it the tech bubble. The tech bubble was financing everything by using debt, by using venture capital, constantly coming to the IPO market. That was how they were financing everything. And when you did hit a bit of a blip, it became very difficult and a lot of that financing dried up. This time around, those that are financing the major infrastructure, I mentioned Alphabet, Amazon, Microsoft, Meta, they're self-funding it through their own internally generated cash flows because they have these amazing core businesses that are cash generating. So yes, you're probably going to have the hype cycles and we may overinvest in certain parts of the market. But I think the biggest difference to point out is just how they're financing it and the companies behind it. So that's probably the biggest difference that I see.
Yeah, and AI is now starting to drive the leadership in the market, but you also said earnings are driving the market. So, how are you thinking about earnings outside of the heavily dominated AI companies? Like, what's happening underneath that narrative?
Yeah, I think that's an important point just to touch on the first quarter earnings season. It's shaping out to be one of the strongest in years. We've got double-digit growth and high beat rates across the board. So to your point, artificial intelligence is obviously driving significant earnings growth, and technology and communication services, which are the two sectors that have a lot of the AI-related names, they're definitely leading the way. But I also cited that 7 of the 11 sectors of the S&P 500 are recording double-digit earnings growth. So there is broad strength. You have AI-related themes that have incredible growth, and then the rest, you do have sectors that are growing strongly at double digits, just not quite as strong. So I do think that's still important for the broad economy. I touched on some companies too that had really good earnings growth, and United Rentals being a name. They're the largest equipment rental company. They had very strong earnings growth and they increased their guidance and outlook. TFI International is a trucking company, trucking and logistics listed here in Canada. I touched on their strong earnings growth. I don't want to go into too much detail because we've only got a little limited time, but Caterpillar, General Dynamics, US financials all did really well. So it's more than just AI was kind of the message that we were getting across. It's been a pretty solid earnings season and earnings expectations have risen. And I think that's a big driver to the market.
Yeah, and I guess really those developments are also a big driver of the durability of the economy, like you talked about. And in previous podcasts, we've discussed recession fears and consumer spending. Frame up what this earnings season then means in terms of the GDP growth and all the data you talked about in the beginning relating to the economy.
Yeah, so if you've got a good economy growing, we always say labor market's probably the most important part of the economy. So if corporates are doing well, that means their labor market's generally holding in solid. Layoffs generally come when corporates aren't growing their earnings, they aren't growing their top line, and they have to cut costs. And so the reason we focus so much on labor is you can have consumer sentiment, you can not like certain things, but generally you don't change your spending habit once you lose your job. Losing your job forces you to change spending habits. And so right now, the strong corporate earnings growth is driving that labor market that I touched on. The last 2 months have been pretty strong in terms of non-farm payrolls. And so I think that's what's leading to a pretty decent economy. Now, obviously, we have the issues with energy prices, and we keep touching on this is all on the understanding that this is a short-term elevated energy environment. We saw inflation prints over the last couple of weeks have been elevated on the back of higher energy prices. And again, if you can withstand higher fuel prices at the pump for a short duration, but the longer that this goes on, it starts leaking into the rest of the economy and everyday goods and services start increasing. And then you have overall inflation rising again. I think that would be a worry for the economy. But right now, if this doesn't go on for months and months, we seem to be in a strong position that the consumer can handle it.
Thanks, Andrew. I think that ties together many of the themes we discussed today. I like to always talk about what is in the headlines as well in this podcast, in case our clients are thinking about what they're reading and wondering what our thoughts are. There's been a lot of news on private credit, and our clients are largely allocated to public securities and liquid portfolios. But just what is happening? Let's talk about what feels like an important risk in the environment right now and around private credit.
Yeah, I think that's a good point to bring up because if we didn't have the war in Iran, we do believe that it would be getting a lot more attention. So, first, if you think, even take a step back, what is private credit? So, if you think of it, it's a private banking version of a business loan. So, normally, if a company goes to borrow money, they have two options. They go to a bank and they take out a normal commercial loan, or they go to the public market and issue bonds to thousands of different investors. And then these bonds are publicly traded similar to stock exchanges. But then the third option is what you're calling private credit. Basically, instead of going to a bank or public market, the company goes to a specialized investment firm. Think of Blackstone, Apollo, or Blue Owl are probably the three largest. And so private credit really took off after the financial crisis when a lot of banks pulled back on their lending. So if you think of that first source of funding was to go to the banks, obviously most of those were under significant scrutiny post financial crisis. So they pulled back on a lot of their lending. And at this point, this was when private credit stepped in to kind of fill that void. A lot of the times the loans are very custom. They provide an important part of the overall financial system, but it's gotten a lot larger since the financial crisis, where it started as a bit of a niche. It's close to a 2 trillion, call it shadow banking system at the moment, which is similar in size to the entire high yield market in the US, which is publicly traded. So I think the discussion surrounds itself. Private credit itself is not necessarily a problem. It was an important part of financing. It's an important part of financial markets, but the structure and the way they're being sold has become one. So what is unique to the structure of them is one, it's in the name, they are private, meaning there's very limited liquidity and price discovery. So many of these funds have gating features, which limits how much money can be redeemed from the fund at a point in time. So generally it's quarterly redemptions that you're allowed, and it might be 5% per se you're allowed to redeem. So this is not a problem, but it's actually a feature of the product to protect all investors because the underlying loans that are held are not liquid. So you can't allow everyone to get their money back if you can't liquidate the loans. Historically, private credit was sold to institutional investors like pension funds, insurance companies, and these all have long investment horizons. But more recently, these vehicles have been opening up more to the general public, and I don't think they fully understand the credit and liquidity risks that are inherent. So like I said, the liquidity risk being if you're only allowed to get 5% of your capital out per quarter, this might not have been something that everyone was aware of going into it. And then the other thing that comes with the liquidity risk is a lack of price discovery. So this could be difficult for retail investors to understand because a lot of the time these loans are basically held at par on the books until a decision gets made to write the book down in times of distress. So this means one day, you could have a book trading at 100 cents on the dollar, and then the next it could be 75 cents, all because a decision was made by the investment manager. And there's a lot of instances of different fund managers carrying different values for the same loan. And so this is how private investing works, whereas the public markets have much more transparent values within them, and you see movement happening on a day-to-day basis, whereas there's a lot of nuances to private credit that I don't think the average investor necessarily knows. And so to wrap it up, you're kind of saying, is this a big issue right now? I think, again, private credit itself, it's kind of turned into a dirty word, but the actual function of it, there's nothing wrong with it. It's an important part of the market. But the issue is that private credit was a big lender in the software space, and it's gotten hit really hard on the back of AI worries. So investors are starting to get worried about the underlying credits, asking for their money back, which leads to these redemptions that are being gated, which generally leads to more redemptions. Then funds have to try and sell their loans, And all of that kind of is a self-fulfilling issue where maybe you have to sell loans at much lower price than where the market originally thought. So private credit, I would say, is going through its first major cycle. All asset classes do it. The main outcome will be to see who has done good underwriting, who's gotten themselves overexposed. But I think it's also shining an important light on the importance of liquidity in the average investor's portfolio. So I don't think this is a huge contagion risk at the moment where, you think back to the subprime crisis where there was a ton of leverage in the system. I think this is pretty unique to an asset class that's going through its own credit cycle and probably necessary as it had grown so fast. So that's kind of our high level thoughts on private credit at the moment.
I think it's a really helpful and important distinction you made between private credit and liquid investments. And I think the important takeaway is also, like you just said, it's not about predicting an immediate crisis that might be unfolding, but more about understanding where vulnerabilities exist in the market and in certain areas of the market. And this is a meaningful stress test for private credit. So it'll be interesting to watch. Thanks. I think that was a really great explanation of something that's newsworthy right now. And I guess that leads us to, unfortunately, the end of time we have here. I think that we could continue talking because there is a lot to talk about, but our time is coming to an end. So as always, is there anything you want to leave to our listeners before we wrap up here?
No, I think just maybe, I guess, if you're touching on the private credit at the end, my wrap up on, I guess, that would just be it's complicated. There's a lot of headlines that go into it. I don't necessarily think what we're going through right now is a bad thing, but it kind of goes back to what we always say. The most important thing in investing is kind of knowing what you own. And I think that's why we stress knowing the businesses, knowing the companies that we own, their ability to compound capital over a longer period of time. That's still what we focus on. It's not to say there isn't other ways to invest, but there's so many different nuances that can become complicated. And just knowing what you own is still probably one of the best pieces of advice I always try and give. So maybe I'll just leave it there.
No, I think that's great. You've always said that, and you've always talked about staying disciplined, right? Staying disciplined and grounded in fundamentals and earnings growth, and that earnings really remain one of the most important anchors in an environment, especially like this one. Thank you, Andrew. As always, thank you for your perspective. Our clients really value your insight and your ability to bring clarity to the complicated markets. Thank you to everyone who's listening. And if today's conversation raised any questions for you about your portfolio or wealth plan, please feel free to reach out to us at any time. We always enjoy hearing from you. We look forward to speaking to you again next month. Enjoy this spring-like weather and stay well. Thanks again.
This podcast is produced solely for informational purposes and is not to be construed as an offer to sell or the solicitation of an offer to buy a security. The information herein is based on sources we believe to be reliable but is not guaranteed by us and does not purport to be a complete statement or summary of the available data. Any opinions expressed herein are statements of our judgment on the recording date and are subject to change without notice. Any unauthorized use or disclosure is prohibited. Receipt and/or review of this presentation constitutes your agreement not to reproduce, display, modify, distribute, transmit, or disclose to others the content, opinions, conclusions, or information contained in this podcast.